This is a piece our research team put together because we get lots of questions about earnings. They haven't worked that well this cycle, that's for sure. Let's take a look. Interpreting earnings implied volatility. For investors in publicly traded companies, quarterly earnings announcements provide a sudden influx of information. This is often immediately followed by a larger than typical price move. Option traders know to expect this, and the premiums are typically higher for options expiring after the announcement. So these higher premiums equate to higher implied volatility. And as volatility-focused option sellers, how should we view this pre-earnings implied volatility different from typical implied volatility? Tony?
Oof.
Woof.
Oof, I do not know the answer.
So we did a study. We examined the past 5 years of earnings announcements in 22 major underlyings from a variety of sectors. Like we have, I'm not going to read them all up, but we go from Apple to Exxon in here, okay? JP Morgan, Microsoft, it's all the big names.
Sure.
Netflix, we looked at implied volatility just before earnings announcements, the day before for the buy to open announcements. We considered the realized magnitude of the price move as a multiple of implied volatility, and we did the 1 day derived expected move. We contrasted these with the 1 day moves for non-earning dates over the same time frame.
Yeah, that second bullet point, they're just saying they took the implied volatility at the end of the day for those that come out at the end of the day, and they looked at it before the market opens for those that come out before the market opens. That's all they're doing.
Yeah. Closing implied volatility day of, for I guess it's at the close announcements, and the day before before the opening announcements.
That's correct.
I just wasn't used to those. We don't use a lot of the ATC BTO.
Right.
But it's at the close and before the open. This is the frequency within 1 times the expected move. So the theoretical for this is going to be the same for all the different sectors, right? We looked at technology, finance, medical, consumer, industrial, but for all underlyings, the theoretical, because it's just theoretical, is 68%. All right. So then we looked at the earnings and non-earnings. And this, I think this will tell you everything you need to know. So for earnings, because we always talk about earnings being engagement trade, right? And a 50-50 shot kind of thing.
Yep.
So for earnings, we found that the actual win rate was, or the frequency, I'm sorry, not win rate, but the frequency within the 1 standard deviation move. You could still have a win rate higher than 45%. Because this doesn't include the premium that you collect, right? We're only talking about theoretically landing inside the move. Are you following me?
I'm following you. Yeah.
Okay. So the theoretical chance of landing inside of that 1 standard deviation distribution curve is 68% of the time. Forget about option premium for a second and just think about where the earnings land. When it's an earnings move, it's 45% of the time. When it's a non-earnings, it's 89% of the time. Remember that person that wrote in earlier and said, I have a small account and should I stick to 45 days or should I do more occurrences if I include 0 days in earnings? And the answer we said was no, stick to the 45 days. Here's your reason. So in the technology sector on earnings, the number dropped down to 31%. It was the worst. It was the most difficult of all of them, almost impossible, to kind of gauge. With the theoretical at 68 and the actual at 31, it's like I said yesterday, I hate these technology earning plays. They just don't work.
Yes.
But the non-earnings is 88%. And then finance was a little better, 51% to 89%, medical 42 to 91. I mean, none of these are great. Consumer, obviously the best because it's closest, and same with industrials. When you look at
closest, but it's still far relative to its own. I mean, like you're saying it's closest, yeah, but it's garbage for earnings. It's really what it's showing.
It's crazy interesting how around earnings, how the chances of staying inside the zone are how much more scrambling you have to do. With non-earnings, how little scrambling you have to do. The difference here is crazy. This is the 1 standard deviation. Now let's take a look. Let's go to the 2 standard deviation. So when the theoretical is 95%, does that help? And the answer is sure, because it gets a little bit better. Now remember, you're not collecting nearly as much money, but you go to finance, these numbers tighten up a lot, except in technology. If you go to 3 times, which is, now remember, 3 times is not, we don't sell premium. 3 times, we don't sell these options. Just to be fair, like because I don't want anybody to email me say, you guys, why don't you just do these? Because we don't trade the two delta options, the 1 and 2 delta options. Okay. We just don't ever sell those. But I thought for purposes of just giving you the visual, you can see here that when you go to a 3 standard deviation, or you're basically selling a one delta, 2 delta option, you can get it to the point where it's, where it's across the board pretty good, except for technology. That's the worst odds in the world.
Yes. Yes.
I think this is one of the more powerful market measures that we've done ever to show the difference between earnings trades, which are 1-day binary trades, and the 45-day expiration trades. It becomes so apparent here why it truly is like a talking point, an engagement trade, but not something that you want to
Longevity.
You're not mortgaging the house, or you're not betting. That's not your trading future at all. I think that in the future, when you think about this and just think about like kind of the classic 1 standard deviation move, the 16 delta strangle, and and you look at the earnings trades here at 45% of the time they stay within that range. That this is as crapshooty as you get.
Right.
But non-earnings at 89% is as mechanical as you can get. Earnings can be a wild time for underlying prices. Even adjusted for IV, large moves were significantly more than on a typical day. When it comes to earnings, the expected move is less expected than usual. This was especially true for major technology equities, which saw drastically more outlier moves around earnings. If you do try and take advantage of higher earnings premiums, keep position sizing small, you get less IV overstatement edge than you do on the average 45 DTE trade.
Which you would have been told in years past the exact opposite. Like earnings, you're going to get that huge volatility contraction.
Yeah, but not on our show. We have not said the opposite.
No, not on ours.
We've been preaching the same thing we've been preaching this for a long time, but this information.
Very good, sir.